Welcome back to All Things Money. I'm your host, David Blain. During this segment, we're going to talk a little bit about what's going on in the markets today, the stock markets, bond markets, commodity markets, what it means for your portfolio, how some of the defensive sectors, defensive type things, the risk of those has gone up. Now, in our firm, we still believe that a diversified portfolio has merit. There was an article in the Wall Street Journal the other day about how, is 100% stock the right answer? For a certain segment of the population, sure. For a lot of people, the answer is still going to be no, that the volatility is just too much. In fact, as you go out, if you have invested, you go out and you open your brokerage statements this month, or you get an email, I shouldn't say open, hardly anybody gets it mailed to them anymore. If you open your email and look at your brokerage account, or you log on to your 401k and look at it, you may notice that it may be lower than you anticipated. The reason for that is last month, the month of May, there was quite a bit of volatility in the market, and a lot of your typical defensive type sectors really did very poorly. Now, the stock market, so to speak, as measured by the S&P 500, was up 1.29% in the month of May. So if you had it all invested in the S&P 500, well, good for you. You made 1.29%. This is where it gets really strange. If you look at the utilities sector in the United States, investing in stodgy old income-paying conservative utilities, Duke Energy and Florida Power and Light and things like that. The return in the month of May for utility stocks was minus 9.05%. They lost almost 10% of their value in 1 month. We see a lot of the conservative markets last month were down. Bonds, we see TIPS, 15-year TIPS, minus 9%. Foreign real estate, minus 10%. 20-year Treasury bonds, minus 7%. Gold was down minus 6%. There's that gold again. REITs, U.S. REITs down about 6%. So there was a lot of volatility in the market last month. A lot of your conservative, bonds, utility stocks, things like that, REITs that pay income, anything that paid income last month really took a very hard hit. And the reason is, with all the stimulus going along, not just the Federal Reserve, mostly the Federal Reserve, but it's happening all over the world. Japan is doing things, the Euro bloc is doing things, and you see people just reaching for yield, buying, dividend stocks, higher yielding stocks, interest rates being artificially low. And so whenever there's a whiff of the Fed may cut back its bond buying and let interest rates rise, you see this massive decline in the value of things that pay income. And so last month was quite challenging. Some things that went up: U.S. large companies, U.S. small companies, the technology sector, consumer discretionary, things like that. But anything conservative last month was down. And that brings us to sort of the great quandary as we look here at, the end of a huge downward sloping interest rates that started in 1980. You had 14, 15% interest rates down to today. Huge tailwind for bond investors and people that have been conservative. A conservative put their money in safe treasuries, have been making 6, 7%. Well, recently, because the declining yield on the treasury, somewhere between 1.7, 2% for the 10-year, you see people moving to REITs. You see people moving to dividend-paying stocks. They're looking for ways to create that income. And as a result, some of those sectors of the markets have become overvalued. And when there's a whiff of inflation or rising interest rates, those sectors get hurt pretty badly. And so it's really sort of backwards, and things that people regard as safe are becoming actually risky, and the things that people regard as risky have actually become somewhat more safe because of their valuations. Now, so this is really a factor, as I mentioned, that the Federal Reserve trying to keep interest rates at zero, and it's forced income investors out of U.S. government debt and into riskier type investments. And the lingering concerns over the economy, 2007, 2008 are still fresh in people's mind, even all the way back to 2001 and 2002. And so people are, very concerned about what to do, and if they are investing in stocks, they've been sticking with those type of sectors that are considered less volatile, such as your utilities, consumer staples, and things like that. So as we're going forward, you just need to be very cautious about sort of piling into the latest fad. There's been a lot of talk about low volatility investing. The same thing, people have been investing in a lot of these low volatility funds or ETFs. Those got hit pretty hard because of the increased valuations that they had. Now, there are some concerns about the bond market and where things are going to go if interest rates rise. Make no mistake, we are very concerned about that. The ability of high quality bonds to buffer the decline in the stock market is still there. It's not going to be the same when you have interest rates starting at 5 or 6% and are able to decline to 1 or 2%. You get a much bigger buffer. That's what happened in 2007, 2008. When the stock market started going down, you had interest rates coming down, which raised the price of treasuries. Well, starting from the rate where we are today, you don't have as much room to go, and so treasury bonds and high quality bonds are they're not going to be able to provide the same buffer that they did previously. They will be able to provide some buffer. It's not like the buffer is going to go completely away. So they will provide some buffer, but not like we've seen before. So what's an investor to do? I mean, it's the great quandary, and that's why we wish that the Federal Reserve and Bernanke and all these people would just get out of the markets and leave it alone, because they've created what I like to call it polynomics, the merging of politics and economics, and the traditional economic models and investing models and things that we have, they don't work correctly when you have so much heavy-handed intervention by a central bank or government authority. So anyway, that's just some of the things to look out for as you're searching for yield. Be careful about piling into some of these seemingly safe dividend-paying stock type investments.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.